Hello and welcome to this session on raising equity through other sources. In this session, you will learn about private placements, qualified institutional placements, venture capital, and follow-on public offer. Let's begin with private placement. A private placement is a capital raising structure which involves the sale of equity to a small number of private investors such as mutual funds, large banks, and insurance companies. The target investor are a small number of chosen investors. This method is generally cheaper than an IPO. The advantage is that securities do not have to be registered with SEBI or SEC and are subject to regulation under Regulation D and Securities Act of 1933 in the US. Different rules under Regulation D provides stipulation for offering a private placement, such as the required financial criteria for investors or solicitation allowances. Investors could be banks, insurance firms, or pension funds. In many cases, detailed financial information is not disclosed, and the need for a prospectus is waived. Since the placements are private rather than public, the average investor is only made aware of the placement after it has occurred. Qualified institutional placement, or QIP, is a capital raising tool used in India and Southern Asia, where a listed company can issue equity shares to qualified institutional bidders at a pre-decided price. Qualified buyers are those who are deemed financially sophisticated and are legally recognized by security market regulators to need less protection from issuers than most public investors. In the Indian context, SEBI allows an Indian listed company to raise capital from its domestic markets without the need to submit any pre-issue filings to market regulators. Indian companies were accessing international funding via issuing securities such as American Depository Receipts, also known as ADRs, in outside markets. This was seen as an unwanted export of the domestic equity market. So, the QIP guidelines were introduced to encourage Indian companies to raise funds domestically instead of tapping overseas markets. Coming to venture capital. Venture capital is also known as startup equity capital or risk capital and is provided by investors such as financial institutions. It usually comes from venture capital firms that specialize in building high-risk financial portfolios. So how does venture capital industry work? Venture capitalists borrow money from private investors as well as issue IPOs to gain capital from investment bankers. Entrepreneurs, on the other hand, have ideas that they pitch to venture capitalists. If they seem interesting or feasible, venture capitalists fund the project by injecting cash. As mentioned previously, venture capital is usually only used with high growth industries where risk is much higher. Venture capitalists exit the business once they have earned ample profits. They primarily offer to sell their stake of shares to the existing business owners or managing directors to avoid dilution of shareholding pattern. But the offered price is way too high than the market price. In case the offer is not accepted by owners, then the capitalists go to public for sale, thereby exposing the firm to market risk and dilution. With venture capital, the startup company issues private shares in exchange for money. Venture capitalists typically assist at four stages in the company's development. First, idea generation. Second, startup. Third, ramp up. And fourth, exit. A follow-on public offer or FPO is when an already listed company makes either a fresh issue of securities to the public or an offer for sale to the public through an offer document. This is often the case if the company's original IPO included a lock-up period during which the founding shareholders were not allowed to sell their shares. Follow-on public offers thus give these shareholders a way to monetize their positions. In the case of the dilutive offering, the company's board of directors agrees to increase the share float for the purpose of selling more equity in the company. When new shares are created and then sold by the company, the number of shares outstanding increases, and this causes dilution of earnings on a per share basis. The non-dilutive type of follow-on offering is when privately held shares are offered for sale by company directors or other insiders who may be looking to diversify their holdings. Because no new shares are created, the offering is not dilutive to existing shareholders. Usually, the gain of cash inflow from the sale is strategic and considered positive for long-term goals of the company and its shareholders. This new inflow of cash might be used to pay off some debt or used for needed company expansion. We have now reached the end of the session. We hope you found it insightful. Thank you for your time.